Let's get more on the U.S. markets now with my next guest, Jeff Taylor, Managing Director at Digital Risk, and he joins us live from Washington, D.C. So we were just talking about Twitter. We had an earnings beat there. Still, investors are disappointed. They're selling off in after earnings. What's the sentiment on Wall Street right now?
I think the sentiment on Wall Street is, especially if you look at high tech, I think recently they're starting to focus back on some of the legacy companies, the stalwarts, the Microsofts, the IBM. The financials have really started to disappoint a little bit. But what's really interesting when you look at the banks is typically there's an interesting number. A loan to deposit ratio generally is around 97%. Banks currently are hovering right now around 77%. That goes to tell us there's over 20% of capital they could be deploying across different asset classes, and they're not doing it right now. So I do look for the banks to be able to pop up sometime in the next 6 months and really improve their earnings.
All right, people on the sideline, what's going to get them in?
I think people on the sideline are going to have to feel secure. The big tech run-up has definitely spawned a lot of anxiety to the extent people do remember 2000. So I think they're going to have to feel like they're actually really getting strong value. And again, when you look at what's going to get people to come back in, the biggest area right now that's dragging down is the U.S. housing market. Although we have historically low interest rates, we're still not seeing that first-time home buyer come back to the market. We're still not seeing them make the decision to invest in a house as a long-term wealth-creating opportunity versus renting. So I think we're going to have to see a combination of those things going forward.
All right, let's talk about earnings because we have a little bit of a mixed picture. The earnings season for this quarter started off with a little bit of a bang, and now it's looking a little bit more muted as more tech companies come through with earnings here. In terms of forward guidance, what do you think earnings outlooks are going to be from larger companies as they try to manage expectations?
That's a great question, and I think everybody is starting to adjust downward a little bit. They want to manage the expectations, so they're starting to peel back their earnings a little bit so that when they come in, they possibly don't get hit as hard. The tech sector is obviously, it's really sometimes it's difficult to peg because there's a lot of enthusiasm, they see the growth, but the numbers aren't there, so it becomes much more of an emotional trade. So again, I think the larger companies are paring back and hoping that they ultimately get treated better when their earnings do come out.
What's a good strategy in this environment?
I think a strategy in this environment is you have to be honest with yourself. Are you in it for the long term or are you in it for the short term? If you're in it for the long term, pick the brand names that have been successful for the last 10, 15 years, put your money there. If you are very enthusiastic about the tech sector, get in, but allocate that percentage of your portfolio that you know is going to be a little bit more at risk, and then really stick to the fundamentals and the strategy, giving yourself a time period to stay in them for a while. I do think over the long run, the U.S. market still has quite a bit of upside upwards.
All right. So, of course, we have Janet Yellen speaking at an event on Thursday. Of course, the FOMC coming out with its meeting outlook, essentially. And what is the expectation from you, from Wall Street, from investors as to the guidance? We got a lot of guidance in March. Is April going to be a little bit more muted, quiet there?
I think she's going to give pretty much the same guidance. I think she's going to be staying the course a little bit. And what we're going to see probably is, again, a reduction in quantitative easing a little bit more. But ultimately, these historically low interest rates aren't necessarily driving the growth on some of the lending side, home ownership, that we thought we would see. So I think we're going to get continuing the same message. But again, the U.S. economy definitely is not recovering the way I think that anybody necessarily hope that it would be, again, driven by the housing market, but hopefully we're going to get some more positive reactions in the second half of this year.
All right, Jeff Taylor, managing partner and co-founder, Digital Risk, live from Washington for us. Thanks so much for that, Jeff.